People talk about the U.S. revaluing its gold because right now, I mean, we claim to have a lot of gold in Fort Knox, and we're holding it for accounting purposes at, like, I think $45 an ounce. So a lot of people say, well, we'll just revalue that gold for $5,000 an ounce, and then that will give the Treasury a lot of new borrowing power. That doesn't make any sense to me because, I mean, the whole world knows how much gold we say we have, and they can do the math. They can know what that gold is worth. So us just changing a note, some notations, gold has been basically humanity's money for 3,000 years now. And to make sense of that, you kind of have to understand what money is. And to understand that, you have to go back to before there was money. The original human civilizations were based on barter, where if I have some arrowheads and you have some beaver pelts, we work out a deal and we do a trade and move on. But as societies get more complex, they can't function on just barter because that requires too many trades to get from, say, speech therapy to pork chops or something like that.
Right. Right. Mm-hmm.
So every society starts looking around for something to serve as a kind of an intermediary, a communications medium, and a store of value. That is what money is. So that throughout history, we've tried human slaves and animals and bales of dried tea leaves and big rocks, and all of them worked a little bit, but not very well. And eventually people settled on pieces of metal like gold, silver, and copper because they can be made in identical pieces, so you know exactly what you're getting. They're all rare, so they tend to hold their value. And gold ended up being the best of all of those things, and it stayed as humanity's money up until like 1971. The problem with using a rare thing as money is that it limits the ability of governments to just go out and invade their neighbors and buy elections and do all the things that governments like to do. So governments hate the limitations on the money supply that being on a gold standard monetary system imposes.
We all hate limitations on our money supply, don't we?
We all do that, yeah. And so the difference being, though, that governments can actually grant themselves the ability to create money out of thin air. And so in 1971, they basically all did that. We went off the gold standard and we went to what is called a fiat currency standard. Fiat being government decree. They tell us this is the money, therefore it is the money. And since that time, since it basically handed an unlimited credit card to the world's governments, they've totally abused that power. And we've developed into a society where debt increases exponentially. Everybody is basically either benefiting from the increase in debt or debt slaves now. So you've got kind of an aristocracy in charge. The people who get the money first when the Federal Reserve creates new money out of thin air tend to get richest because they get to use that money before the increased supply lowers the value of that money. And so now we've got a society where we're basically at the very end point of that fiat currency experiment that started in 1971. We've built up so much debt that the debt has become more than unwieldy, and it's now a mortal threat to the global financial system, and there's no fix. So that's the stage of this process that we're living through right now is historically unprecedented, and it's going to be just fascinating from an economic nerd standpoint. I'm just really interested in what's going on. Most people, it's going to be terrifying though, because the average person doesn't obsess about this stuff every day, and they aren't expecting it to happen and they aren't preparing for it to happen. So they're going to be caught off guard. And in other words, the people who don't deserve to be hurt are the ones who are going to be hurt by the monetary chaos that's coming. And that leaves a lot of online talking heads, kind of like me, trying to tell people what they need to do to get ready for the chaos that's coming.
Civilizations experimented boldly to solve barter inefficiencies. Many objects and even people were tested as trade standards with mixed success. Livestock could walk away, stones couldn't move easily, tea spoiled, and human labor was unreliable as a stable store of value. Money needed universal communication value, permanence, and divisibility. As trade routes connected continents and kingdoms grew into empires, The demand for a neutral exchange bridge intensified. Identical units became crucial so people could price labor and goods confidently. This quest shaped economic history for millennia, steering humanity toward metals, resources that could be minted, measured, and verified.
Gold is the form of money that we pile into when we become terrified about what the government is doing to the money that they're managing. So gold tends to rise in local currency terms. In other words, when you measure gold with the currency that is being inflated away, the price of gold goes up. And so that's one of the things you can do to protect yourself from monetary chaos is you move out of the currency that your government is inflating away and into real things that governments can't inflate away. And that can be farmland, it can be oil wells, it can be solar farms, it can be really well-chosen rental houses, but it can also be gold and silver. So you get into those two things, those are actual money, and we're going to go back to them as money in the not-too-distant future. And as people figure this out, more and more of them move into gold and silver. And, what happens then is that those are small, thinly traded markets. There just is not that much gold and silver available for purchase when people really get nervous and start trying to buy it. So the price goes up, and then towards the end of the cycle, it'll go up dramatically where, you have gold just going to numbers that don't even seem possible right now, and silver going up much faster than gold in percentage terms because it's more thinly traded. There's just less silver out there in the world. And so that is, you could basically call that the investment thesis of the coming decade. You want to move out of financial assets and into real things like gold and silver.
Gold, silver, and copper proved uniquely fit for economic function. They could be melted, reshaped, stamped into equal units, and traded over distance without degrading. Their scarcity preserved purchasing influence across generations. Gold stood above the rest, resistant to corrosion, culturally valued, visually distinct, dense for storage, and globally recognized. Ancient Egypt, Greece, Rome, and later merchant kingdoms built monetary systems around it. This metal-based discipline prevented reckless overspending and forced governments to operate within real reserves. Even today, central banks collectively hold thousands of tons as financial insurance, notably increasing purchases since 2022, a sign of shifting trust toward hard assets.
The past couple of years actually have been spectacular run for gold and silver. Gold, for instance, bounced off of the $2,000 an ounce level like 3 or 4 times heading up to last year. And then it finally broke through and it just took off. Now it's like $4,100 an ounce. So it's doubled in a couple of years, which for a form of money, for a large asset class like gold, that's a huge move. And the mining stocks are basically sold as leveraged plays on gold, because what a gold miner is basically a bunch of gold in the ground and then some machinery to get that gold out. So it's kind of like buying gold in a bank vault or something like that. If it's a well-run mining company, they're going to pull that gold out of the ground, sell it for the new higher price, bank a ton of cash, and then do, you hope, favorable things with that cash. And in a gold and silver bull market, of which we've had a couple since the fiat currency experiment started, the miners usually go up even faster than the underlying metals. But of course, they have a lot of risks associated with them that you don't get with just the metals. But if a gold or silver miner is really well run and honestly run, and they have what they say they have in the ground, a lot of them are what is called 10-bagger stocks. In other words, they can go up 10 times from where you buy them. And there are a lot of them out there right now. They've had their good initial runs. So the very easy money has been made in the mining sector. But a lot of the really good ones have a long, long way to run from here if gold and silver continue to go up. I think there's a pretty good bet that gold and silver continue to go up because the governments of the world have no choice but to inflate away their currency. Like you said, they even if they don't like inflation, because it's a politically risky thing to do, but it is their one way out of an unmanageable pile of debt. And so they're going for it now. I mean, Look at what the U.S. government is doing. Even with conservatives in charge right now, we're running $2 trillion a year deficits. And now they're starting to talk about 50-year mortgages and $2,000 stimmy checks, which are basically just panicky ways of getting themselves through the next election. So when stuff like that starts happening, that's a sure sign that financial trouble is coming, and gold and silver are probably safe bets to get yourself through them.
In 1971, the dollar detached from convertibility to gold, reshaping global finance. Modern currencies became fiat-based, valuable primarily because governments enforce legal tender status. This created inflationary latitude previously impossible under metal backing. With spending no longer constrained by reserves, public debt expanded rapidly. U.S. federal debt now exceeds levels considered stable, while deficit spending persists near historical peaks, surpassing trillions annually. Discussions around longer mortgage terms and stimulus-style payments demonstrate political pressure to prioritize short-term stability over fiscal restraint. Economies globally mirror this strain as borrowing costs and inflation concerns dominate household budgets.
Yeah, when you're in kind of a currency death spiral like we are now, lots of different sectors will get in trouble. It's not everybody at once going bankrupt in one big week or anything. It's some local and regional banks, and then it's commercial real estate, and then it's private equity. And the government, when confronted with a crisis in one sector that's not dominant but reasonably big, can either let it happen and hope that the crisis doesn't spread to everything else and knock down all the dominoes and just end today's monetary system tomorrow. Or they can step in and try to put out that small fire by bailing out the entities that are in trouble. And that's what the governments have been doing for the last 30 years, basically around the world. And that's what our government is doing now, or has been doing with local and regional banks. Basically, the smaller banks out there have a lot of real estate paper, for instance. They own a lot of bonds based on office buildings or loans to office buildings. And the office building sector is kind of tanking right now. And what happened more recently is some private equity companies, which are these shadow banking kinds of things that aren't regulated the way regular banks are, but still do things like banking. They got into trouble. And everybody was wondering who else was going to blow up after those 3 or 4 private equity companies blew up. And so people started looking at local and regional banks, for instance, and some of the big banks too, and thinking, okay, is my bank going to go bust? And then they were considering pulling their deposits out, and that could really metastasize. So the government stepped in with basically a bailout, which is what they call repos, where the government will take some of your asset-backed bonds and give you cash in return. And that cash allows you to pay off your depositors if they want to pull their money out. And that keeps you from going bust.
Sounds like a Ponzi scheme.
Lately. Oh, it's totally a Ponzi scheme. Yeah, it absolutely is. We're in that phase of the process. And so the government does that. The government has already done it once before, very recently, with the local and regional banks. And so they're doing it again with banks now. But it could easily be the car makers next, or some other branch of the banking sector. You just don't know who's going to blow up in a situation like this. Lots of people are going to blow up. Yeah.
Today's financial system contains banking, shadow lending, and real estate credit intertwined across global balance sheets. Regional banks often carry significant property-linked debt exposure. Commercial real estate, particularly office space, remains pressured post-2020 as vacancies stay elevated. Large unregulated capital pools, including segments of private equity and leveraged credit funds, create unpredictable points of stress when liquidity tightens. Governments historically responded by swapping distressed bonds for cash to prevent deposit runs, a pattern repeated across decades. Each intervention expands the money supply further, intensifying currency dilution risks. Market psychology shifts quickly when confidence in stability fractures.
People talk about the U.S. revaluing its gold because right now, we claim to have a lot of gold in Fort Knox, and we're holding it for accounting purposes at I think $45 an ounce. So a lot of people say, well, we'll just revalue that gold for $5,000 an ounce, and then that will give the Treasury a lot of new borrowing power. It doesn't make any sense to me because, the whole world knows how much gold we say we have, and they can do the math. They can know what that gold is worth. So us just changing a note, some notations about the value of the gold for official purposes doesn't change the world's perception of U.S. financial stability in any way at all, And so if we were now to use that gold to go on as a gold standard, in other words, to back the currency in a way that that makes the currency stable and trustworthy, yes, we'd have to do it at a much higher price. That's not what those guys are talking about when they're talking about revaluing gold. They're talking about just allowing the Treasury to borrow a lot more money. But if we use the gold that we have, assuming we actually have it, to back the U.S. dollar by, say, 40%, in other words, gold accounts for or equals 40% of the dollars that are outstanding and circulating, you would need a way higher gold price for that. So the people who run those numbers and decide what 40% or 60% or 80% backing would mean for the gold price all come to the conclusion that the number is way higher than today. It's $10,000 an ounce and up. Some estimates are up in the like $40,000 range. So if we went back to a gold standard, that would mean the dollar price of an ounce of gold would go through the roof. So if you've invested in gold, you'd like that scenario, right? We go back to a sound money standard, which is a good thing, and you get rich because you've got a bunch of gold at $10,000 or $20,000 an ounce. So that's the gold bugs' dream scenario, right? That they don't confiscate our gold, but they do use their gold to go back to a new gold standard at $10,000 or $20,000 or $30,000 an ounce, and conceivable. There's some speed bumps along the way, but that is a thing that's possible in this world. Well, bull markets always have corrections because what happens when some asset has gone up in price for a while, that creates a lot of people with profits to protect, right? And so they're trying to figure out what they should do about it. A few of them decide to sell a little bit of their holdings. That spooks the other people who are worried but haven't yet started to sell, and then they sell, and then you get a correction. Sometimes that correction is stomach churning because you get a lot of people who panic sell because they don't want to be round tripped. In other words, they don't want their asset to go all the way back down to where they started. So they take something, they bail at some price that's positive for them. And that's very scary when it happens if you're not one of the ones who sold right at the top. But bull markets have corrections like that, and then they get going again, and then it goes up to some new high level. And you're very sorry if you sold during the first correction. And with gold and silver, the thing that dictates their value isn't anything they do. Gold and silver are just basically rocks that sit there. What determines their value is what we're doing to the dollar. In other words, as the U.S., for instance, is still taking on more and more debt year after year and still creating a lot of new currency out of thin air to finance that debt and the interest costs on that debt, then that means the value of the currency is going to continue to decline as the oversupply gets worse and worse, which means gold and silver, when valued in dollars, will continue to get more and more valuable. So corrections, especially this last correction, by calling it a head fake, I was quoting somebody else with that, but the term head fake means, it's something that is kind of designed to fool you, to get the weak hands out of the market, to allow the strong hands being defined as people who have no intention of selling for a really long time, to come in and get one more last shot at cheap metal. And that's basically what happens. Well, gold and silver fell pretty dramatically, and then they stabilized, and now they're back up again. They're down today, but gold is back up above $50 an ounce, and silver is back up above $50 an ounce. Gold is above $4,000 an ounce, which is a nice high level. That's a bull market place for those things to be, and so. Whether you should jump in with both feet at this price, that's a different story, but you definitely shouldn't just sell out here. or at least if this is the kind of bull market that past bull markets have been, then you don't want to sell here. You can take a little bit of profit, but you want a nice, solid position in these assets because they have a lot longer to run based on the things that determine their price.
Historically, precious metals appreciate when major currencies face sustained expansion. Gold recently surpassed psychological thresholds, signaling investor repositioning. Silver historically moves more aggressively due to smaller market liquidity, delivering higher percentage swings in later stages of cycles. Well-structured mining equities have historically outpaced the metals during strong trends, even producing exceptional multi-X returns, though with higher operational and governance risks. With fiscal pressures elevated globally, diversification into non-inflatable assets, metals, land, structured rentals, agriculture, and energy-backed infrastructure is rising as a core theme for the coming years. Strategic positioning now could shape financial resilience ahead.